In this month's Economic Update, Kaplan Professional Education's Michael Pollack speaks to an industry economist about the short-term domestic and global economic outlook.
Welcome to Kaplan Professional Education's monthly economic update. I'm Michael Pollack, and this month we're speaking to Sun Super's Chief Economist, Brian Parker. Thanks for joining us today, Brian.
Pleasure to be here.
So, Brian, how well do you believe the Australian economy is coping with the end of the mining investment boom? Where's the growth coming from?
Well, the short answer is, as to how we're coping, the short answer is better than we usually do. If you look at previous episodes where Australia has had a big boom in our terms of trade, whether it's been mining related or agriculture or both, we typically handle the aftermath really badly. I mean, a lot of people right now are saying, well, look, the economy is only growing at 2%. That's really anemic. Why doesn't somebody do something about this? If you look at a broad sweep of Australian economic history, the fact that we've avoided a recession thus far is a pretty major achievement. The fact that we have a more flexible economy, the fact that we have a floating currency that has started to actually do what you want the currency to do at a time like this, in other words fall, is providing a really nice cushion for the economy right now. You are seeing growth outside of mining coming through. It's not just housing and it's not just house prices. You are seeing activity in services in general. You're seeing activity in healthcare. You're starting to see the early signs of a pickup in tourism that's showing up in a pickup in accommodation and food services and things like this. So you are seeing growth outside of mining. It's just that obviously, given the extent to which mining made such a major contribution to Australia's growth, that has hit particular industries in particular states and regions particularly hard.
If construction and price growth weakens in the property sector, what are the likely ramifications for the RBA's monetary policy stance?
Well, look, on balance, I think there's very few ramifications for monetary policy. Let me explain. On the one hand, your obvious response is to say, well, if house prices and if housing construction weaken, that means the economy needs more help, so the Reserve Bank would have to cut interest rates. But at the same time, you've already got the lowest interest rates in living memory, which begs the question, if the economy needs more help, is it likely or does it need to come from the Reserve Bank? I think the answer to that is no. The other thing is that I think the Reserve Bank would be fairly happy to see some easing in price growth, or maybe even some modest price declines in housing, in particularly Sydney and Melbourne. That does take some of the pressure off the Reserve Bank. They have been concerned about some overheating in these markets. They've been very, very vocal about that, and rightly so. The other thing to bear in mind, though, is that when we talk about housing and we talk about a boom in house prices, if you venture outside of Sydney and Melbourne, if you venture into the regions or some of our second-tier capitals and talk to them about a property bubble or a house price boom, they'll look at you as if you're from another planet because they've really seen none of it. Certain parts of Queensland and WA, previously mining and gas boom locations, you've seen house prices come off quite a lot. So you've already seen that bubble kind of burst. Now, whether you see the same thing happening in Sydney and Melbourne, I think is an open question. I personally think you'll see over the next few years house prices in Sydney and Melbourne start to level off. In some areas you'll see declines, other areas will hold up better than others. That typically is the way the housing market behaves in Australia. The one caveat, if you want to see housing really take a tumble, if you really want to be negative about housing, you really need to see unemployment rise far more substantially than we've seen so far. So far, unemployment hasn't risen high enough to really put pressure on home borrowers. And until that day happens, it's highly likely that home borrowers will be able to hang on and keep on servicing their loans. And so if that's the case, you're not likely to see the kind of forced sales, the kind of foreclosure sales that might trigger a more rapid decline in house prices.
We've seen the dollar back up to well above 70 cents after a 6-year low of 68 cents in September. Where do you expect the dollar to be at the end of the year?
I think the balance of risks still favours a lower Australian dollar. I mean, obviously it's not as relatively easy a call to make, given that we're now much closer to fair value. We're not at $1.05, $1.10 anymore. So a lot of the big gains from, say, being unhedged in global equities, a lot of those big gains have been made. Now, on balance, I still think the currency has further to fall. I think we will need the currency to fall further, given that I don't think we've seen the end of the Chinese slowdown yet. I think that slowdown does continue. I suspect that we'll see further downside in iron ore prices. And we'll also start to see higher US interest rates. And I think all of those things will continue to put downward pressure on the currency. In the short term, I don't think anyone has any great clarity as to where the currency is heading, but at this point, even at these much lower levels than we've seen, I think the balance of risks still favours a lower Australian dollar in the next 12 months or so.
So what's your outlook for the Australian economy going into 2016 then?
Look, I count myself as a relative optimist, and maybe that's only because I hear so many more pessimistic voices out there. But I think we are seeing enough growth coming through outside of mining and outside of manufacturing, for example. And if you think of the two key sectors that are getting a lot of attention in recent years for their weakness, mining, construction and manufacturing really did cop it from a stronger Australian dollar. Now, outside of those two sectors, the other 85%, 90% of the Australian economy is actually doing better. If you look at the non-mining, non-manufacturing economy, it's generating jobs faster than the overall economy, and it's growing faster than the overall economy. In fact, growth in those non-mining and non-manufacturing sectors has accelerated in the last 12 to 18 months. I mean, it's not brilliant growth, but it's a hell of a lot better than a lot of people are fearing. So yes, there are certain industries and certain regions that are doing it tough, but the economy overall, I think, is in better shape than a lot of people realise. So I'd expect to see, on average, a bit of a pickup in growth over the next 12 to 18 months. Annual GDP growth right now is running at about 2%. I think we'll head up to the high twos in the next 12 to 18 months. That's not an outlandish forecast. That's pretty much consensus, because we are likely to see growth come through. The growth is likely to be more services oriented, it's going to be more micro, and it is going to generate the kind of jobs that we need to stabilise the unemployment rate. It's somewhere in the low sixes.
So just turning to China, after a tough year there, are there reasons to be optimistic about the Chinese economy, or is it likely to experience a hard landing due to factors such as excess capacity, high private sector debt and export headwinds?
Look, I think on balance, I count myself as a relative optimist on China as well. That's not to say that I don't think the economy is going to slow down further. I think it will, but I think that slowdown is likely to be more manageable than some people fear. I think in the shorter term, you'll also start to see signs of a bit of a bottoming out in some of these indicators that people have been watching. A lot of people have been very concerned about the state of Chinese manufacturing, about the property market, but I think you're starting to see signs in the data that some of the policy stimulus measures that China has put in place are likely to show up in perhaps a better set of economic numbers in the next, say, 3 to 6 months. We're not quite there yet, but I think you'll start to see more signs of stability emerge in China. China has been a great story for Australia, for the world, and for the hundreds of millions of Chinese that have benefited from China's enormous development in the last 30 or 40 years. But it's not a story that's without risk. If you look at the history of the way emerging markets develop, it's very, very common that every emerging economy gets to a certain stage, they overdo it, they overinvest, and they end up with a crisis or a mini crisis and a fairly deep recession. Does China have the policy tools at its disposal to avoid that? Well, I think they do, but it does take a lot of very careful management. And I think one thing I would actually want to stress, financial markets in general have put a lot of faith in the ability of the Chinese authorities to manage their economy and to manage this slowdown perfectly. Now, so far they have managed it very well, but I think financial markets this year have started to cast a bit more of a concerning eye on the way China's economy is being managed. I mean, these are very, very challenging times, not least of which for China.
So moving to the US, when do you see the Fed increasing rates, and what will be the major outcomes for the economy?
Look, a couple of things. Firstly, is the US economy strong enough in an underlying sense to be able to tolerate higher interest rates at this point? I think the answer is a resounding yes. Does that mean I think the Federal Reserve is going to start raising rates aggressively? Absolutely not. I think they will be very, very cautious and very, very slow in raising interest rates. That said, between now and year end, if you look at the public commentary of various Fed officials, they would dearly love to be able to raise rates by the end of the year. The data are not lending them any favours. We're not seeing signs of a decent build-up in wage pressures. We're not seeing signs of underlying US inflation rising. I think eventually we will, but will we see that in time for the Federal Reserve to justify raising rates by year end? Frankly, I don't think so. But on a 6-month view, I think you will see higher US interest rates. One thing I would say is that one of the issues I think the Fed is dealing with is that they've kind of over-communicated. I mean, sometimes central bankers need to just shut up. In a way, they've really sort of convinced markets. They've actually kind of added more to volatility. They say that they don't like volatile markets and they don't want to unsettle markets, but I think the Fed's own communication strategy has certainly run the risk of adding to that volatility rather than mitigating it. There's a school of thought that says they should just bite the bullet and raise rates and then we can all move on. Frankly, I have a lot of sympathy for that view, but I don't think they'll come to that conclusion in time for the end of the year. So my personal view is early in the new year, not by Christmas.
So just how well placed is the US consumer right now?
Reasonably well placed, I think, is the way I would describe it. US consumers are still very, very cautious. I don't think you go through a crisis such as the GFC and not have that change consumer behaviour for some time to come. But I think overall, US consumers are getting wage increases, albeit modest wage increases. They do have access to credit. Their housing market is recovering and they're feeling a bit more confident about the world than they were. I think overall US consumers are in reasonable shape. And are US consumers able to withstand higher interest rates at this point? Again, I think the answer is yes.
And what's your outlook for the US economy going into 2016?
I think the US economy does improve over the course of the next 12 to 18 months. I don't think we see very rapid growth. I think we see a very, very gradual rise in interest rates occurring from, I think, on balance early next year. I think growth picks up to, on average, somewhere around the sort of high 2s to 3% in the next 12 months or so. I don't think it gets a hell of a lot better than that, largely because I just don't see businesses racing away and starting to invest. I think we're still likely to see quite modest growth in business investment at this point. I think the outlook for the US could be best described as good but not great, but nevertheless still an outlook which is more than adequate enough to withstand modestly higher interest rates.
So looking now at Europe, is the briefer than expected decrease in the euro this year going to be much of an ongoing problem?
If it were sustainable, then yes, I think it would. But I think you'll see some renewed euro weakness and US dollar strength. So I think that trend will actually resume at some point. The other thing, though, with Europe is it's not just about the currency. If you look at the transmission of monetary policy more generally, I think one of the issues that Europe had was that you had the European Central Bank reducing interest rates to extraordinary levels, as we know. What we've seen in the last, let's call it 12 to 18 months, is you've seen quite a substantial decrease in consumer borrowing rates and corporate borrowing rates, which means that monetary policy the rubber starts to hit the road. It means that it actually is able to have an impact on people's spending behaviour and on businesses' spending behaviour. Now, I think that is actually having arguably a more powerful effect on European growth and Europe's growth prospects than the weakness we've seen in the euro, which, as you point out, has been pretty lame thus far. I think a lot of people were expecting to see the euro quite a bit weaker than we've seen up until now.
And what do you expect to be the drivers of growth in Europe heading into 2016?
I think in terms of overall growth in Europe, I think you'll see the consumer the consumer will actually be the key driver of European growth, I think. I think you'll see decent growth in consumer spending, and given the consumer spending is the lion's share of a modern economy, that provides a very good base on which to build. I also think the fact that you've seen far easier credit conditions and you now have a far healthier banking system in Europe, you have much lower borrowing rates, as I said. You'll also start to see a reasonable contribution coming through from business investment as well. I wouldn't want to get too excited about Europe. I mean, Europe still has its challenges. Public debt levels in a range of European economies are still way too high. There's still a risk that we have to revisit the whole Greek issue, among other countries as well, at some point in the coming years. So I don't think Europe is out of the woods yet, but I do think you'll see reasonable enough growth in consumer spending and reasonable enough growth in in business investment to ensure that Europe continues to grow at a vaguely decent pace. But I wouldn't want to get too excited about Europe's growth prospects.
Thanks for your time today, Brian.
Pleasure to be with you.